So now we talk about dividends from the common shares or from preferred shares. Any dividends given out, there's no contractual obligation, meaning the company does not have to give out the dividends. In the case of the interest, remember, if the company issues a bond, they have a legal responsibility, a requirement to pay out the bond interest. If they don't, then they will be liable for that in the future. So but in the dividends for common shares, preferred shares, it's not a requirement. There will be a date. On that date, it's called the record date. The company will say whoever are the owners of the shares on this date, they will receive the dividend. Every day, thousands, millions of shares are sold and bought every single day. So there's a certain date. On that date, whoever owns it will get the dividend. So come dividend means that anyone who buys the share, they will receive the dividend. And this is said to be, if you calculate it, it's up to the second business day before the record date. So whatever the record date is, you count back 2 business days, and that will be the last come dividend date. So if let's suppose it's 30th of June, if you count back, then 1 and 2 business days means the 28th of June will be the come dividend date, right? So that means that anyone who buys it, they will, so on the 28th, anyone who buys it, the settlement is 2 business days. As you remember, the settlement dates for stocks are trade date plus 2 business days. So anyone who buys it on the 28th, so 29th, 30th, on the 30th, they will be the owner of the shares and they will be entitled to the dividends. So that is the last come dividend date. And the ex dividend date is if you buy the stock, it means you're not going to get the dividend. So that is 1 business day before the record date. In other words, if it is 30th of June, then the 29th is the day, last day. If you buy it on that date, tough luck, you're not going to get the dividend because it will settle on the day after the record date. So this is the concept of the dividends. And furthermore, there are different types of dividends. Regular ones are every year or quarterly, they're going to pay those out. And those are the regular dividends. Unless there's any serious issue with the company, they will continue to pay the regular dividends. And then there are extra dividends. Extra dividends are a bonus. It's additional to the regular dividends, but there's no guarantee that this will continue. In the stock dividends is sometimes the company says we don't have money, we'll give you some benefit, but we're not going to give you the benefit in terms of money. We will give you more shares. So they give additional shares. And this is paid by rapidly growing companies. They will issue stock dividends rather than giving actual dollar figures. And these are treated as regular dividends for the tax purposes. So if you get a dividend, you have to decide what are you going to do. You either can take the money and you can spend it, or you can reinvest that money. If you say I want to reinvest into the company shares again, then what you can do is you can do what is called a DRIP plan. The DRIP plan is dividend reinvestment plan. And with that, you are using the dividends to buy additional shares in the company, and they're not paid out as cash. So but still you do have to pay taxes on the cash dividend and also on this dividend that is reinvested. If you're getting dividend from the company, you do pay taxes to the government, and then that money is used for reinvestment. So what is the benefit for the shareholder? You save on the commission. Instead of having to pay the commission to buy the shares, as you know, regardless of the number of shares you're buying, you have to pay a commission every time you buy or sell the stock. So you don't have to do that. And then there's the benefit of dollar cost averaging also. So that is the other benefit of DRIP, which means that if the share price is going up, you will buy less and less of this number of shares. And that is going to save you money. And if the share price goes down, you're buying more and more of the dividend of the stock shares. And so the dollar cost averaging overall benefits you in that situation.